This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
This week, the Fed takes a backseat with their bunch of benign data to a mega deal in AI land, which lays the groundwork for years more major spending in the space. On today's show, we'll look at what the ramifications of that deal are, with some big benefits and some concerns to consider. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein. There's the usual basket of economic news this week. The markets were heading into this week with a lot of anticipation for what the consumer price and the producer price data would tell us about the future interest rate moves, as the markets had been pricing in an expectation for 2 hikes for what remains this year. But I'll circle back to all that later on in time, as I wanted to start off this week's show by taking a look at the big news of the week. Before I dive into that, it's going to revolve around the stock of which I own, a stock we own for our clients. It's NVIDIA. But while this is about the news of the week, also note, as always, that this isn't intended to be a recommendation. It's not a recommendation to buy or sell the stock. It's not a research report. We have a bias on the name. There's a conflict of interest there. And anything you hear on the show should be discussed with your own advisor, and you should always do your own homework. That being said, Monday night after the close, Jensen Huang, CEO of NVIDIA, appeared on CNBC with 6 of the biggest names in finance. It included CEO of Goldman Sachs, Blackstone, BlackRock, KKR, etc., all together to announce this new coalition of willing lenders that are going to supply capital to the continued build-out of the AI infrastructure and ostensibly fund the payments of all the AI builders, their ability to pay NVIDIA for their chips as these key components as part of that process. And this combined fund, which pledges to lend beyond $500 billion to the builders, has what Bloomberg says has alleviated the worries that NVIDIA was inflating a bubble due to circular financing. And instead, this paves the way for the expansion to continue on, it seems. Partially, Bloomberg says, is that this not only provides a clear source of funding, when so much of it up to now has been in the form of these cashless trades, essentially of goods and services, but it also is bringing relief to the landscape as it creates a group of savvy lenders who are going to be burdening the risks. Well, we'll talk about the risks in a second, but they're at least evaluating the risks. They're going to judge the merits of the individual deals, which harkens back to what was basically missing in the internet boom of the late 90s, which was largely funded by absolutely printing shares of stock, putting it in the shareholders' hands to fund that expansion, which didn't end too well. What's touted as a benefit of this deal by some, and what remains as a challenge in the eyes of others, is that it creates a more transparent marketplace for these elements of the AI universe, specifically, literally the value of computing power being supported by NVIDIA's chips, which allows the collateralization of them in this lending process. And it may boil down to this simplified, if very imperfect analogy. If you look at the value of compute here in these build-outs as collateral, akin to, say, a loan or leveraging real estate, or if you consider it more similar to a depreciating asset like a car. You can borrow more freely and with easier lending standards if you're going to buy a house, because houses historically and typically retain their value. They're an asset which you can borrow off of that's not going to evaporate, while cars lose value over time. One investor in a Wall Street Journal article regarded this deal. He said that the compute power, quote, typically has the shelf life of lettuce, end quote, while NVIDIA themselves are pointing to this continued utility of even their older chips and the value that they're maintaining in the marketplace as an argument that they're more like the real estate part of the analogy rather than the car in this example. But still, the deal does provide an enormous credible source of funding and transfers some of the risk away from NVIDIA to the pool and ultimately to the large pensions and the institutional investors who are going to be expected to buy up all this debt because these institutions or these lenders are not going to carry it. Perhaps instead of thinking this as similar to that dot-com spree of the 1990s, maybe it has more some of the hallmarks of the securitized mortgage obligations of the 2000s, which had a much worse ending. But perhaps we can also remain somewhat optimistic that it has a profitable outcome for the lenders, for the borrowers, and for companies like NVIDIA who remain in the middle of all of this. The Financial Times pointed out that much of the debt for chip purchases is actually structured so that it has to be paid off within 3 to 5 years. So it's structured more like a car loan than a house loan because they understand that the collateral here may be compromised after that much time. But the Wall Street Journal points out that it's not the massive hyperscalers because of their fortress balance sheets that we're worried about the risk of here, but it's the many, many more, albeit smaller, kind of fledgling AI businesses that are also going to be borrowing here to get their businesses started and off the ground and may struggle in some cases to develop or show revenues that are going to need to pay this off in that time frame. Financial Times goes on to note that if NVIDIA itself guarantees that the chips are worth at least 25%, so the structure is that NVIDIA says we guarantee the value in these loans, that their balance sheet is saying they're going to be worth at least 25% through the lease term of these chips. So they are indeed still maintaining some of the risk exposure. So if you look at just the kind of evaluation of their cash flows and all that, note that a lot of what they're selling, if it ain't worth 25 cents on the dollar in 3 to 5 years, they're on the hook for some pretty large exposure there. But ultimately, much like in other boom times, this is a quintessential moment where the so-called moral hazard is being shifted, where the risk is being moved away from the bankers and from the operators onto the public. You know, this has no bearing as to whether they will succeed, whether or not AI will profit or not, but it's to note that if they do not, then a very large burden, trillions of dollars, has been at least partially moved onto the investing public, onto the endowments, into the pensions, and so on. As the Financial Times says, quote, NVIDIA's guarantee has led private capital firms to believe that chip financing deals can be packaged into securities and sold to debt buyers such as insurance companies whose assets they manage, end quote. So they're packaging up all these loans that people are buying the chips with, and they're selling them as kind of a hybrid version of a bond. And the bottom line is that it creates a much clearer source of financing for all this spending to continue, but it also creates a whole new asset class whereby Wall Street has sold packaged mortgages and the like for years. They can now sell packages of debt collateralized specifically by compute power. Most signs still point, and this is why I remain optimistic, just hopefully prudently cautious, but most signs still point to AI being a major disruptor, to be an economic boom, and that we're in the very, very early stages of it. I mean, so early based on the projections of economic scale that the 9-inning baseball analogy doesn't even work because we would be the one strike in the first at bat, I guess. But we are also leveraging to that thesis as a capital market, as a nation, as an economy, as a capital market. And with the scale of all this, it's starting to feel like it almost has to succeed in order to avoid catastrophe. And there may be few options in between. All right, with that bright note, I'm going to take a short break, but I'll return soon with an update on some pretty upbeat economic news with my usual brand of cautious spin on top of it. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
Every asset class, equities, metals, oil, and treasuries seem to trade more and more like crazy meme stocks. Discipline and patience are lost arts. How do you keep focused when others don't? Tune in every week as we discuss the latest financial trends and what investors need to know. To keep your eye on the ball and become a better informed, wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group. Or just find us on your favorite podcast app. Raymond James & Associates Incorporated, member New York Stock Exchange, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James & Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James & Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. The markets, which have rallied nicely in August so far, they're up about 3% for the month while I'm recording this. After a volatile July, which ultimately did result in a pretty modest overall decline in the S&P 500. But there are a lot of eyes on the data this week as we got both the consumer price and the producer price index data for the month of July. And expectations were that inflation would be modest for the month as the on-again, off-again war with Iran saw really a net decline in the price of oil. But the core numbers had some people wondering if we would see an overall pickup in inflation. Because the markets had been pricing in, the consensus was that we would see two rate hikes before the end of this year. And we do have another round of not just various economic data, but these two inflation pieces. One more round of that before the Fed does have their next meeting in September, which some think is going to be their last chance to move rates up a bit before the election, because historically the Fed is believed to be reluctant to do so in October, right before the midterm election. But the data this week was largely benign, with the inflation numbers right at where the consensus had guessed they would be, and continued a pretty flat to modest cooling trend. Still inflation, just not running too hot, still above the Fed's target numbers. As Bloomberg reported, it probably wasn't cool enough to give Warsh license to cut rates just yet, as he was expected to be a pretty dovish Fed chairman. But as the employment data, though, it isn't screaming today for that relief from the Fed. But these numbers did take pressure off of the odds of a near-term hike and multiple hikes, and interest rates followed that by falling throughout the week. That being said, although this likely reduces the odds of a hike, I still wanted to pay some lip service, maybe to calm the fears that impending hikes are a reason to move away from equities. I will also mention, and I may have said this on a recent podcast, that despite the markets being pretty resilient recently, regardless of who's in office, and ultimately regardless of who wins the elections, if you look at the past 100 years, the quarter which we're in right now, the quarter that leads up to the midterm elections, is historically the most volatile and the worst performing quarter of the 16 quarters of a presidential term, while the quarter that includes but follows the election and finishing the year is on average the best performing quarter of the 16, including a rally that typically continues into the first quarter of the next year. But in similar fashion, markets often see volatility leading up to the first rate hike of the start of a Fed tightening cycle. Per research from JP Morgan, market pundits spend the months that lead up to that first hike debating whether a hike's going to come and what it's going to do to the economic conditions. However, once the hike actually happens, that removes the uncertainties, similar to that election cycle thing. But according to Goldman Sachs, the S&P 500 has averaged a small overall decline of about 2% from recent peaks in the first 3 months after the first rate hike. Then investors recognize that hikes are usually happening during strong periods of strong economic growth, And while they may reprice valuation premiums on some stocks, the S&P 500 has historically had positive returns over the subsequent months after that first rate hike. And per that report, the same is mostly true after a second hike, but after the third rate hike of the cycle, performance is still on average positive, as then the effects of inflation are really starting to be affected and on the decline. But they point out in the report that sector leadership, and I thought this was important, sector leadership in the markets then starts to change during this phase, as they call it. The hikes at that point have squeezed the steeper premiums that were found in the former market leaders, while the previously less favored sectors, but those names that still demonstrate strong free cash flows, that had reasonable leverage, they start to outperform as it's reflecting this reversion to the mean because they were at discount valuations relative to the market, and everything starts to come together, overall moving in the right direction, but those that had been defying gravity fall a bit to earth. They note here that a major exception was in recent memory in 2022, because we saw sharp increases in inflation, you must remember, and then sharp increases in interest rates with elevated valuations heading into that period because we had these big stock rallies during the pandemic. And then the hits from the supply chain disruptions happened, overall led to a decline in the S&P 500 of almost 20% from its high in 2022. Now, since that's not similar, I would say, to today's environment, but rather hikes may be seen, albeit perhaps less after this week, but they may be seen from inflation trending higher than the targets, but with still strong underlying economic conditions and not really radical inflation. You could argue that the historical comparisons may be a more appropriate guide here today. And that may help prepare us for hikes, which we may or may not see later this year. One other note worth noting this week was that the New York Fed issued a report regarding household debt in the country for July. And this very same report was interpreted differently by multiple sources. At Raymond James, Larry Adam noted a rare decline here in overall household debt. He said that this was the first such decline in household debt that we've seen in 6 years, along with fewer delinquencies, which were driven by lower mortgage balances. He also noted that credit card, auto loans, and home equity balances moved higher, which he said suggested that the consumer remains willing to keep borrowing and spending. However, the report itself noted that the percentage of credit card balances that are more than 90 days past due jumped from about 8 to almost 13% in the second quarter. It may also show that the consumer is still borrowing, but they also may be doing so because they have to, as they're confronted by higher costs. Total credit card balances rose by $21 billion in the country to a total of $1.26 trillion, which is just shy of the all-time high, which was made last year. And that total credit card balance debt is up about 2% from the previous quarter. So these are two different pictures and conclusions about the consumer economy based upon the same report. And while I guess consolidating the two would suggest that the consumer does continue to spend, perhaps spending more on the same amount of goods, while maybe racing towards a Thelma and Louise style potential cliff of credit card interest payments, especially if they start seeing higher interest rates on top of it, which I didn't mention during that Fed rate cycle part. At least in general, the consumer remains largely employed today by the data. And although wage inflation and household income has trailed overall consumer inflation in recent months, which all goes to explain some of this credit card debt. All right, that's it for me this week. I actually have just one more show in me before Labor Day. But until then, for the Wise Investor Show, I'm Chase Hinderstein. Thanks for listening in.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.